Happy Friday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. It is the end of a big week. We have a lot to cover. Let's jump in. And we begin as we usually do in North America. Investor anxiety surged across global markets Thursday as President Donald Trump's tariff strategy reignited fears of a global recession, triggering a fresh wave of sell-offs in stocks, bonds, and commodities. Wall Street, which had briefly rallied after a 90-day tariff pause announced on Wednesday, reversed dramatically as new duties on Chinese imports and persistent trade volatility undermined investor confidence. The S&P 500 tumbled 3.5% by Thursday's close, wiping out the previous day's gains, while the dollar slipped to its lowest levels since October. This week has been nothing less than a rollercoaster for markets. This video goes up a few hours before the North American market opens again, and no doubt we'll see a lot of volatility during Friday trading. Liquidations in US assets intensified yesterday, with investors seeking safety in gold and the Swiss franc, both of which surged to a multi-year high. Oil prices continued their descent, and long-dated Treasury yields rose sharply despite solid demand at bond auctions, reflecting broader market distress. Quote, "This is the beginning of a monstrous bear market," end quote, warned Bill Smed of Smed Capital Management. One trader even went as far as saying full financial collapse could be on the cards. These comments reflect the growing belief that Trump's second-term trade maneuvering may derail the US recovery. Others stand by the US administration, however, arguing that it's only been 1 week, that much of this volatility is short-term, and that short-term pain is to be expected, but that medium to long-term stability is on the horizon. Of course, whatever happens remains to be seen. A key concern for markets in the short term at least is the uncertainty around US tariff policy. Quote, "Even in emerging markets, we have no idea what policies are," end quote, said Kim Forrest of Bokken Capital, adding, quote, "But here in the United States, we can no longer do fundamental analysis of some of the best companies," end quote. As equities plunged and volatility spiked, the VIX fear gauge jumped above 40. Goldman Sachs raised its recession odds to 65%, only to dial them back slightly following the temporary tariff reprieve. Still, sentiment remained bleak. Quote, "Policy uncertainty remains very high and is likely to weigh on consumer and business activity," end quote, Goldman analysts wrote yesterday, Thursday. It is worth noting that tariffs are already making revenue for the federal government. New data published yesterday showed that customs duties were 35% up year-on-year in March. However, with Wall Street now pricing in a recession, investors are bracing for months of uncertainty, if not worse. Meanwhile, in a glimmer of hope, US inflation showed a surprising and broad-based cooldown in March, providing a rare piece of good news for consumers amid escalating tariff tensions. The latest Consumer Price Index, CPI data, released Thursday by the Bureau of Labor Statistics, revealed that core inflation, excluding food and energy, rose just 0.1% from the previous month, marking the smallest monthly increase since July. Overall, CPI declined 0.1%, the first drop in nearly 5 years, driven by falling prices in energy, used cars, airfares, hotel stays, and vehicle insurance. Notably, the 0.1% decline in headline inflation came as a surprise, with none of the 67 economists surveyed by Bloomberg forecasting a drop. Annual core inflation slowed to 2.8%, the lowest rate since early 2021, as shelter costs, traditionally a major inflation driver, climbed just 4% over the past year. While the report predates many of the tariff increases recently enacted, it suggests price pressures were easing even before the latest trade shocks. Let's now move to Europe. The Cabinet Office in the UK is set to lose nearly a third of its workforce as part of Prime Minister Sir Keir Starmer's sweeping cost-cutting agenda across Whitehall. The department announced Thursday that around 2,100 of its 6,500 roles will be eliminated over the next 2 years, largely through voluntary exits and reassignments to other departments. Cabinet Office Permanent Secretary Kat Little unveiled a restructuring plan aimed at creating a leaner, more specialist department aligned with the government's broader goal of saving £110 million by 2028. The move comes amid concerns the department had become bloated and unfocused, taking on policy challenges considered too complex for other ministries. Quote, "We are creating a leaner and more focused cabinet office that will drive work to reshape the state and deliver our plan for change," end quote, the department said. However, the FDA union, which represents senior public servants, warned the cuts could undermine the very reforms they are meant to support. Quote, "There's a difference between reforming and cutting," end quote, the FDA Assistant General Secretary expressed in a statement, adding, quote, "Ministers will now need to be honest about what the government will stop doing," end quote. The Cabinet Office is responsible for supporting the Prime Minister and ensuring cohesion across departments. This reduction is part of a wider effort to cut 10,000 civil service jobs across Whitehall and shift funding toward frontline services such as education, health, and policing. The world is going through massive transformation with big changes happening by the hour. If you want to be on top of the most up-to-date financial and economic developments as they happen, consider subscribing to Market Update, hit the bell notification icon, and you will be. And if you're enjoying this episode, don't forget to hit the like button. Next up, we move to Asia, and we return to the global market turmoil. Asian markets plunged on Friday, led by a sharp sell-off in Japan, as global investors reacted to Wall Street's overnight collapse and fresh fears over the escalating US-China trade war, topic which we discussed in great detail on my other channel, China Update, which should go up within the next hour or so. Tokyo's Topix index sank nearly 5% in early trading, with major exporters like Sony and Toyota tumbling more than 9% and 6% respectively. Financial heavyweight MUFG also fell 5.5% as the yen surged 1.2% to its highest level since October at 143.2 per dollar. Japan's finance minister, Katsunobu Kato, emphasized coordinated efforts with the United States to mitigate currency volatility. The ripple effects extended across Southeast Asia. Despite brief rallies on Thursday following a temporary 90-day US tariff reprieve, stock markets in Taiwan, Thailand, and Vietnam remain deeply in the red for the year. These China plus one nations, favored by Western manufacturers seeking alternatives to China, now find themselves caught in the crossfire of tariff retaliation and shifting global supply chains. Economists warn that ongoing uncertainty could deter foreign investment and delay supply chain reconfigurations across Southeast Asia. Vietnam, despite impressive long-term growth and strong export links to global giants like Nike and Samsung, remains vulnerable due to limited foreign exchange reserves and US scrutiny over potential transshipment of Chinese goods. Still, analysts point to resilience among some Southeast Asian economies, such as Indonesia, which boasts stronger reserves and greater policy flexibility, even though this year to date, the Indonesian economy has had a bit of a rough time. As tariff tensions persist, Asia's emerging markets face a complex balancing act between opportunity and risk in the global trade landscape. It is no surprise then that Southeast Asia, especially players like Vietnam, have sent trade delegations to negotiate with Washington to ensure these export markets remain open. Whether they are successful and what the cost of that market access will be remains to be seen. Meanwhile, Japanese Prime Minister Shigeru Shiba has launched a government task force to tackle the mounting economic fallout from new US tariffs amid growing concerns over inflation and slowing global growth. Speaking Friday, today, Shiba warned that the tariffs, quote, could have a major impact on all kinds of industries, end quote, and directed Economic Revitalization Minister Rosei Akazawa to continue negotiations with Washington while preparing support measures, including financial aid for domestic firms. In response to consumer unease over rising prices, particularly for food, the ruling coalition is reportedly weighing a temporary cut in consumption tax. The proposed tax relief comes as Shiba faces increasing pressure to act on cost of living concerns, with his approval ratings lagging. The 25% US tariff on Japanese cars has intensified worries over economic growth, casting uncertainty on the Bank of Japan's next interest rate decision. While some US tariffs have been paused, the ongoing trade tensions have forced Japanese policymakers to reconsider their strategy and seek swift responses to shield both consumers and key industries. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. There may be an episode this weekend. In the meantime, have a good Friday, have a restful weekend, and I will either see you this weekend or for a new week of updates on Monday.